Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to today, Thursday, the 2nd of November, and the Bull versus Bear webinar. Steve Miley here on the Call for Trading. Welcome, everyone. We're going to go for our usual regular run through in here today. We're going to take a look at some articles from the major newswires. Also, the reports that I put out here are going to start there on a daily basis, the bond reports and also the cross assets, so the index reports and the oil and the gold reports. We're going to start off with those, run through articles from the major news wires, what are the what's impacting financial markets right here, right now, and we'll also take a look at the calendar, see what we've got coming up, and then a quick dip into the charts as well. Any questions, please feel free to throw them in the chat. If you want to say hello, let me know you're there. Please do say hello. We had a blackout period yesterday, just a few pieces of housekeeping. Blackout period yesterday, 2 minutes before or after the Fed, no trading. People are starting to take note. Very few traders fouled on that yesterday. And we have another one of those tomorrow, I'll remind you. Another one of those tomorrow. US employment report. We'll be back on the webinar tomorrow. I'll remind you ahead of the webinar. Ahead of the data, but it's the US employment report. No trading 2 minutes before or after that data. And remember, in some parts of the world, the time difference between wherever you are and the US may be different at the moment. So please do keep that in mind when we go not only to the data points, but also on the close, on the market close. Okay, so keep all of that in mind. Right, I'm going to start off in here with the bond markets. And the bonds, we saw significant rally in bonds yesterday. Two things driving that. So, hi there, Ben. Thanks for saying hi. Anyone else want to say hi? Please say hi. So two things drove the bond markets higher yesterday. One was the market interpreted comments from the Fed as kind of positive for the economy, and maybe that they won't be hiking rates. Okay, they pointed to the fact that bonds, the rally that we're seeing the sell-off that we're seeing in bond market, this big sell-off that we've seen in the bond markets in here through the summer, has obviously seen bond markets go down in price. Remember, down in price equals higher in yield. So higher yields equals higher long-term interest rates. So longer-term interest rates have been going up. And not only longer-term, but, we go, look here, that's the 30-year. We look at the 10-year. Same thing, bond prices down, yields higher. The 10-year broke 5%. And that's been the tail of the tape. We've been going down in price, higher in yields. And we've been talking about this before, that markets have been looking at that, and maybe the Fed won't need to tighten. Some of the Fed speakers before the Fed blackout period, the Fed speakers were saying, these higher yields. Remember, higher yields translate into higher mortgage rates. Okay, higher mortgage rates. That's going to put a brake on the economy as people come to remortgage, as new buyers come to the housing market and they take their mortgages out. They're going to be at higher rates, so that's going to naturally slow the economy down. Okay, so the Fed have been pointing to that. And the market knows that as well, right? So these higher yields maybe mean that the term that was being used was that the market, as in the bond market, the treasury market, was doing the Fed's dirty work for them. What does that mean? Well, it means that the higher yields in the bond market means that the Fed maybe won't need to hike rates, okay? Because naturally, longer-term interest rates are going up without the Fed actually changing their short-term interest rates, okay? So that's what's been happening, and the Fed kind of nodded to that in the I think Powell, I don't think it was in the statement, but it was in the Q&A. Powell said that in the Q&A, in the press conference, and also in the statement they acknowledged that the economy was doing relatively well. Okay, the economy was doing well. That was the main change in the statement, that the economy was doing well. So both the economy doing well and the Fed maybe not needing to hike interest rates, the market liked that. Yeah, not only the stock market liked it, but the stock market mostly liked it because bonds went up in price. Bonds like that. Okay, they like the fact that maybe the Fed won't be hiking, and they like the fact that the economy is relatively robust. Okay, so the bond market rallied yesterday on the back of that. Now, it wasn't only that. The other thing that sent the bond market higher, we had the statement from the actual US Treasury. Remember, the Fed and the Treasury are separate. The US Treasury were announcing future bond sales, and there was a lot of concern that because of the the issue with spiraling government debt in the US, that the US bond sales would be higher, okay, and higher, greater supply in here could mean then lower prices, right? More, we were looking for potentially more supply, and potentially more supply at the longer end of the curve, and obviously more supply. Okay, if you just at any market you increase the supply, increased supply would lead to lower prices, okay, and then lower prices equals higher yields. And that was the concern for the market. Well, what actually happened was it came in kind of in line with what original expectations were. There were fears that it was going to be more supply, and the fact that there wasn't more supply, the market kind of liked that as well. Okay, so that was positive for the bond market. So the bond market went up on both of those events, both the Treasury not increasing supply as much as was feared, and then also on from the Fed. That the Fed did two things. One, they gave a nod to the fact that the economy is firm, and then they also gave a nod to the fact that the higher interest rates may mean they might not hike. Now, Powell also said we're going to, there's no decision made on the December meeting, and there might still be a rate hike. And if we jump quickly to the CME Fed tool in here, obviously November is no longer on here. We now see this is leapt higher, right? 80% now for the December meeting that we stay unchanged. Only a 20% chance that we increase rates. And if we continue to go out in here, the January meeting was still at 525, 550. Remember, 525, 550. And then by the time we get to March, now there's a 13% chance we get a rate cut. There's still chances that rates might be higher, but there's a 13, nearly 14% chance we get a rate cut by March. But still, the likelihood is by March. So remember, higher for longer. It does look like the market has been pricing and continues to price in the Fed were done at their last rate hike, which was back in the summer, right? So they haven't hiked rates since the back end of the summer. And so we're looking for the Fed maybe to be already done. And if they do it go again, it's probably December and then done. But it's now less likely. You say December, only an 80% chance. Actually, oh God, this has gone up since maybe that's just updated. Maybe I needed to refresh that. That's at 85% now. And that's moved, I think, maybe in the last few minutes. So only a 15% chance we get a rate hike by the end of the year. But it's not till now June. If we go all the way up to June, then you see in here 500 to 525, okay? We're currently 525 to 550. That's when the rate cut is expected, the first rate cut. If we go to the May meeting, it's still at 525, 550. But a growing chance over here, look, that even by the May meeting, we're going to get the first rate cut. So the market is more positive on rates, that rates are, one, not going to go any higher, and two, maybe coming down a little bit sooner than we expected. So that's a positive. And then also the Fed acknowledged, one thing, rates not going up, and two, that the economy was strong as well. That the data since their last meeting has been positive. GDP data, PMI data, the employment data has all been relatively strong since their last meeting. So all of that has sent, and this is the most important thing for me. I'm a technical analyst. I know when I come on here, I do all the macro stuff, but I'm a technical analyst at heart. And we've reflected this in here. We're already starting to shift more positive in here. But now we've seen bases. I pointed out all these peaks, these swing highs that we had from the second half of October. Here at 110.16 on the 30-year bond, we pushed. You've got a basing pattern now, higher highs and higher lows. We're getting reversals. We're pushing up through. Look, you can see the Fibonacci retracement levels I'm putting on here. We're halfway back from this sell-off that we saw in October. We've got half of that back now, okay, on the 30-year. I'm not going to go through all of them in here, but you can see in here 10-year even better. Yeah, we're over 50% up from the October sell-off. We're way through this swing high from October. And again, in year 5 year, it's all the same. Even more emphatic move higher. Now challenging this down trend line that comes all the way from July on the 5 year. And the 2 year has already led the way in here. We're already way through this this trend line. Even if you redraw this trend line through this point here, you're through that trend line as well. We're way through this peak in here. And now we're heading towards the October peak on the 2 year. Remember, this is the short end. This is more reflective of what we're expecting from the Fed. So we're looking for, in here, higher prices, lower yields in the short end, because there's less and less chance now the Fed are going to hike, and more chance they're going to cut earlier than we anticipate. So this has been more sensitive to the Fed. Remember, the long end is more sensitive to the economy. okay, how the economy is doing. So in here, we're seeing this certainly this push higher because an expectation of maybe a more dovish Fed. Remember, dovish, less likely to increase rates, more likely to cut rates. What's going to be really interesting, what we need to monitor over the next few days and going into next week is the Fed speakers. Remember, they've been on their blackout period. Go and jump into here onto the Fed blackout period in here. They've been on blackout in here since a week and a half ago. Okay, so going down to November, so since the 21st of October they've been on blackout. So we're going to get Fed speakers coming through. I think they're still on blackout today, maybe not, but we'll take a look at the calendar. But we'll get Fed speakers certainly coming through as of tomorrow. Okay, and so we're looking out for Fed speakers the rest of this week going into next week. Are some of those that are more slightly sitting on the verge of hawk dove, are they shifting to a little bit more dovish, meaning we're unlikely to get another interest rate hike? We've already seen the peak in rates, so we're watching out for the Fed speakers. So this bullishness, this switch to more bullish, this basing in on the prices, remember, higher prices, lower yields, has then also echoed and reflected. Remember, there's been a positive correlation. You can see it here. Look, let's just go and look at the 2-year note. Down in here, and then pushing back higher from the late part of October. And if we go and take a look at the indices, it's kind of not quite the same, but similar. So down from August in here on the indices, but only the reversal back higher, only really coming in here over the last few days, and an acceleration higher yesterday for both the S&P and for the Nasdaq in here. And from my perspective, and from a technical analysis perspective, we're shifting bullish in here. Short-term bottom is established in here. Bullish, shifting to a more bullish view. We've been negative because we've had this bigger downtrend from August, and we've also had the latest move lower that we saw in October. But now it looks like we're starting to at least reverse the October down move. So a short-term base and maybe a better base is starting to establish itself. So now coming at this on a day-to-day basis, and then going to look at this, playing this more from the long side rather from the short side after yesterday's price action, and that has been driven and reinforced by the fact that we've got the bond markets shifting more bullish. Okay. Right, let's move forward in some of the macros in here. So I kind of, looked at what we had yesterday. Just actually going back to yesterday as well, though, we did have two pieces of data. So let's just quickly talk about that. We had the ADP data. So that was slightly worse than expected. We expected 150, came in at 113, but it was really kind of overshadowed by the Fed. And remember, this is only a kind of a prediction number. It's not the official number. We get the official number tomorrow. We also had the ISM data in here, PMI data. So the actual ISM number in here slightly missed on expectations, again disappointing, and the prices paid number was above expectations, only slightly above, but even that's in green, that's a negative because we want the prices paid to be lower because we're worried about inflation. So both of those were negative. So the data we had yesterday was actually negative on the economy, negative overall for manufacturing, and negative in here on the prices side. So that's a little bit disappointing, but that was kind of trumped by, by the fact that we both had the FOMC statement, and also that supply announcement from the Treasury overpowered the actual data that we saw yesterday. Looking into today on the macro side in here, we did get German unemployment here, worse than expected. I've got a little article on that. So that's a little bit disappointment. The powerhouse of Europe, the world's, what I think is third largest, maybe fourth largest economy, third largest economy, is struggling a little bit in here. So that's a disappointment in here from Germany. And then later this morning, in fact, in 15 minutes, we get the Bank of England decision. Very much anticipated for them to stay unchanged. They were unchanged, which was a bit of a surprise at the last meeting. But it's also interesting. I know you guys are all focused on the US and you're looking at the Fed and you're looking at US markets. But, the UK economy, the fifth, sixth largest in the world. So it's important to watch these other economies, what their central banks are doing, what they're going to say as well. Are they upbeat about the economy? Are they downbeat? The soundings are they're going to be fairly downbeat on the economy, actually. And obviously inflation in the UK is still relatively high compared to the rest of the world. We went very much higher than everywhere else, and we're much slower coming down on the inflation data. So we'll be watching out for that. That's just in 15 minutes time. Moving through the day in here, we do get durable goods and factory orders data at 10 o'clock Eastern time. Watching out for that. It's not particularly big data. Also initial jobless claims, they always have this as 3 in here. It's not a 3, it's a weekly data. I've been in the markets over 30 years. This has never been this has never been a big piece increases there. This was big during COVID because we were looking at those weekly numbers on the jobs reports. But outside of COVID, this number has never been a significant number, even though they still put it with 3. On a lot of websites, they still have it as important. It's not an important. It rarely moves markets to any significant degree. Even though this is a 1 and factory orders is a 1 and is a 2 and durables in here a 1. These are more likely to move the market, but still these are probably not going to do too much for us today. It's fairly quiet on the data side from the US today, apart from, and I'm going to jump in here across to this tab. So on the investing.com earnings calendar, we'd get Apple, but that's not up till after the bell. So after the market closes this evening, we get Apple. It's the last of the big tech to report. So we're going to certainly be watching that to see how Apple are doing. Not only important as big tech, but it's also important as a consumer good. So we'll be watching out for that as well, going after the close, to give us an indication of how the global consumer is doing through the potential slowdown that we're going through in here at the moment. Okay, let's go through 5 things to start your day. So markets cheer power, we've already kind of covered that. Looks like the US Central Bank now be finished, hinted that they may be finished in here. Should we hike more? Powell told reporters yesterday. Slowing down has given us, I think, a better sense of how much more we need to do if we need to do more. Banker's decision today, we've already spoken about that. Jamie Dimon is actually from he's actually talking about Texas in here, but I mean, he's also been on the tape saying about that he still thinks the Fed needs to hike more. Dollar was down and treasuries were up. We know about that already in here in the wake of that. And Apple is the earnings reports. You've got some others in there as well. Starbucks, Moderna, Peloton, Coinbase all reporting today as well. We do have some durable goods data, we already mentioned that. St. Louis Fed interim president Kathleen O'Neill is the lone Fed speaker, so we do get a Fed speaker today. What else do we have for you? So yeah, just running through. Powell hints Fed is done with hikes and cheered by markets. So yeah, markets were up with that. Fed signals yields rise, reduce need to hike. So that's what we're talking about. The market, the Treasury market doing the dirty work for the Fed. I've covered all of this already. Stocks, bonds gain on hope rate hikes are near an end. We've already talked about that. Bank of England likely to do the same on Thursday. Futures tread higher on bets on end of Fed rate hike. So all of this I've covered already in here, but just wanted to run through them anyway. Shares and bonds rally, all the same articles really. Oil up as well, kind of going into more of a risk on scenario in here. Obviously the conflict in the Middle East has remained contained, and so we're seeing oil push back higher as we kind of move back into this risk on scenario on oil. But if we go back and look at my report in here on oil from a technical standpoint in here, yes, we've had like a little bit of a rebound in here this morning, but yesterday we were down lower and it still looks negative. This looks like a bigger topping pattern. We're breaking down through this 81.31 low, coming up to this 80.20 low, down through there. Really signals a bigger topping pattern, and we've got this longer term trend line that comes all the way up from May. So oil is actually looking more negative despite everything that's going on in the Middle East. Oil looking more negative despite us moving more back towards a risk on scenario, despite it rebounding in here overnight. Bigger picture, I still think oil is pointing lower, and that's positive for stocks because a lower oil price takes away from some of those inflationary pressures. What else do I have for you in here? Just a few things in here. So this is more, I'm going to share this one. Hopefully this is not in one of the, I think when they have these the big take ones, anyone, because I've got a Bloomberg subscription. So where are we in here? So I'm just putting this in the chat. Hopefully you can read this one. But I thought this was just interesting more than anything else. I haven't read it all yet. But I mean, basically saying, the bond market is not where traders go, right? Bond market is like, pension funds. It's like long-term investing. People do trade bonds, and are in and out. But it's not particularly exciting, fast-moving market necessarily. Day traders trade it. I've got a lot of friends who are successful, treasury bond traders and German government bond traders, Bund traders and gilt traders as well. But it's not kind of what you cast as like a sexy market, right? But nevertheless, in here, this market, this talking about, volatility. We've had a lot of volatility in the bond market of late. We've obviously seen a big trend lower in bond prices, and now they're reversing and trending back higher. And this is just talking about long tail alpha hedge fund in Newport Beach, California, focusing more on treasury bonds and doing 4 times as much as they previously do. We've had Bill Ackman, a public bet against treasuries. We had Druckenmeier yesterday on the tape saying he's got a massive position in 2-year notes. Bonds are becoming a little bit more flavour of the month, and I thought it was just an interesting article. So maybe take a read at that at your leisure. Bank of England, we're going to look at rates staying where they are, and we've already spoken about the German unemployment higher than expected in here. Let's just have a very quick, and it will be a quick look on the chart. So, because you've got there's the bond market. This is what I've been talking about. Bond market reversing higher, looking a lot more positive. This is the US 10-year future, looking a lot more positive in here, and upside pressures from bonds. And just a quick nod in here to the, just come out to a daily chart on the, this is oil. So despite the oil rebound, look, it's just rebounding from ahead of this low in here, and we've highlighted this low earlier on. So that low is 80.20. Yesterday's low was 80.30. If we take out 80.20, this looks a lot more negative. So watching out for oil, because that would actually be a positive for stocks if we broke down through that 80.20 level. So watching that as well, watching for any upside levels as well. Go take a look at the reports back here that you get. They're just below where you're watching this webinar right now. If you're watching this live, go take a look at the reports. Go and look at the resistance points for all of these: the US 2-year, the 5-year, the 10-year, the 30-year. Maybe put them as alerts on your trading platform, because if we break up through the resistance points on bonds, we're going to break up higher as well, probably on stocks. But the stocks are still very much following the bond markets. I've been talking about that for over 2 months in here now. So go take a look at the levels there. Okay, just a quick nod then, and we'll go to all the levels are in the reports in here. But you can see S&P in here heading towards this swing high up here. That's up at 42.90.5, up through there. That looks a lot more bullish, so still pointing higher there on the S&P, looking for a challenge up there. And if we go to the NASDAQ, on the daily, we've already taken out this impulse peak here. That's the big one. It's some ways away in here, but 14.94875, looking for a push above there going into the day. Even though these markets are up notably today, and just jumping across to that, so Asia was up decent. Nikkei was up over 1%. The Hang Seng was up 0.75%. European bourses this morning already up between 1 and 2%. The CAC's nearly up 2% already in here today. So we could have some big moves in here. And if we go to, obviously we're up about 1% on the S&P yesterday. The Dow Jones up 2/3, and already this morning, if this can load up, already this morning we're up. The Nasdaq's nearly up 1% already, but this could be, and then the S&P up 0.6. This could easily be a 1.5% day for the S&P, maybe a 1.5 to 2% day for the Nasdaq. Okay, because the market is taking a lot of cheer from those two events: the Treasury sales, okay, not being as aggressive as feared, and then also the slight shift to a slightly more dovish tone. The day after Fed is often a quite volatile day. You often see big ranges. So don't think though that looking at the chart in here, like the Nasdaq is already up significant. Look what it was up yesterday. We could have seen what we saw yesterday today again. Okay, so watching out for a significant move higher again today. And obviously we've got Apple coming up after the bell, and then tomorrow we've got the employment report as well, and we get PMI data tomorrow as well. All right, guys, I'm going to wrap up there. Any questions? Nothing's come through so far. No questions. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another bull versus bear webinar tomorrow.